The hidden truth about trading losses. Have you ever stared at your screen, watching a trade go deep into the red, feeling that familiar knot in your stomach tighten? You're not alone. The dirty secret of the trading world is that losses aren't just inevitable, they're essential to your growth. But here's what separates amateurs from professionals: it's not how often you win, but how you handle your losses that determines your long-term success. In this guide, I'm taking you behind the scenes of my own painful trading journey, from catastrophic account meltdowns to the counterintuitive psychology that transformed my approach to losing. By the end, you'll understand why some of the most profitable traders in the world actually celebrate their losses, and how you can turn your trading defeats into your greatest competitive advantage. Drop a comment below sharing your most painful trading loss. What happened, and what did it teach you? Let's start healing those trading scars together. My $27,000 trading lesson. I'll never forget that fateful morning in March 2019. After a 3-week winning streak trading crypto futures, I was convinced I had cracked the code. The market was following my analysis perfectly, until suddenly it wasn't. Bitcoin had formed what looked like a picture-perfect bullish pattern on the 4-hour chart. I went all in with 5x leverage, sizing up my position to make up for some earlier smaller wins. Within hours, a surprise announcement triggered a cascading liquidation that wiped out 60% of my trading account, $27,000 gone in what felt like minutes. I didn't just lose money that day. I lost confidence. I lost sleep. I questioned everything I thought I knew about trading. The worst part? I broke every risk management rule I had carefully established during the previous months of consistent profits. But looking back now, that devastating loss was worth every painful dollar because it taught me something no trading book or course ever could. Losing properly is the cornerstone of trading success. Have you ever broken your own trading rules and paid the price? Share your experience in the comments. Sometimes knowing we're not alone in our mistakes is the first step to recovery. The anatomy of a trading loss. What's really happening in your brain? When you take a losing trade, what's actually happening inside your brain is fascinating, and understanding it can transform how you approach trading entirely. The neurochemistry of loss. When you see your position moving against you, your brain releases cortisol, the stress hormone that triggers your fight or flight response. This floods your system with adrenaline, physically preparing you for danger. Your heart rate increases, your breathing shallows, and most critically, blood flow to your prefrontal cortex, the rational decision-making part of your brain, decreases. This neurological hijacking explains why even experienced traders make impulsive decisions during losing trades. Your ancient survival brain takes over, treating the financial threat like a physical one, and rational thinking becomes nearly impossible. I once conducted a personal experiment, wearing a heart rate monitor while trading. On winning trades, my heart rate averaged 72 BPM. On losing trades, it spiked to 115 BPM, the same as moderate exercise. My body was literally responding to the red numbers on my screen as if I were being chased by a predator. The 5 emotional stages of a losing trade. Most traders cycle through a predictable emotional pattern when facing losses. 1. Denial. This is just normal market noise. My analysis is solid. 2. Anger. This market is manipulated. These whales are targeting my stop loss. 3. Bargaining. If this just recovers, I'll close the position and never oversize again. 4. Depression. I'm a terrible trader. Maybe I should just quit. 5. Acceptance. This trade didn't work out. What can I learn from it? The problem? Most traders get stuck in stages 1 to 4, never reaching the critical acceptance phase where actual growth happens. Which stage do you typically get stuck in? Comment below with your most common emotional response to losses. Awareness is the first step to transformation. Why most traders never learn from losses. The hard truth is that most traders waste their losses. They experience the pain without extracting the wisdom. Here's why. The blame game. The most common response to a losing trade is finding something or someone to blame. The market is rigged. That news announcement came out of nowhere. My broker hunted my stop loss. That trading guru gave me bad advice. While some of these complaints might occasionally be valid, blaming external factors robs you of the opportunity to improve. Every loss contains a lesson if you're willing to look for it. The revenge trading trap. The second destructive response is revenge trading, attempting to immediately win back your losses with larger or riskier positions. This emotionally driven approach is like a gambler doubling down after a losing streak, and it rarely ends well. I once turned a manageable $500 loss into a $3,000 disaster through a series of increasingly desperate revenge trades. Each new position was based not on sound analysis, but on the emotional need to get even. This is the trading equivalent of pouring gasoline on a fire. The selective memory filter. Perhaps most damaging is our brain's tendency to create false narratives around our trading. We remember our winning trades as brilliant analysis, even if they were lucky, while dismissing our losses as bad luck, even if they resulted from poor decisions. This selective memory creates a distorted self-image that prevents real improvement. You can't fix problems you refuse to acknowledge. Have you caught yourself blaming external factors for your losses? Share your experience in the comments. Sometimes the most powerful growth comes from honest self-reflection. How professional traders turn losses into assets. The difference between amateur and professional traders isn't found in their win rates, it's in how they process and leverage their losses. Here's how the pros transform trading defeats into long-term advantages. 1. Embracing the positive expectancy mindset. Professional traders understand that individual trades are merely data points in a much larger statistical game. They focus on positive expectancy, the mathematical formula that determines profitability over time. Positive expectancy equals win rate times average win, loss rate times average loss. When you understand this formula, you realize that losses aren't failures, they're simply one part of a profitable equation. This mindset shift changes everything. For example, a trader with a modest 40% win rate can still be highly profitable if their average win is 3R and their average loss is 1R. 0.4 times 3R, 0.6 times 1R, equals 1.2R, 0.6R equals 0.6R positive expectancy per trade. This trader will lose more often than they win, yet still make money consistently. This is why professional traders don't fear losses. They simply ensure those losses remain small and controlled. 2. Creating a loss ritual. The most psychologically advanced traders I know have developed specific loss rituals, structured processes they follow after every losing trade. These rituals transform the emotional sting of loss into a productive learning experience. My own loss ritual includes taking a 10-minute walk to physically reset my nervous system, documenting the trade in my journal without judgment or emotion, identifying one specific lesson or insight from the loss, visualizing how I'll apply this lesson in future trades, expressing gratitude for the tuition payment that taught me something valuable. This simple process transformed my relationship with losing trades. Instead of dreading them, I now see them as unavoidable tuition payments on the path to trading mastery. 3. Tracking your loss cost. Professional traders track what I call their loss cost, the average amount they pay for their trading education per month. If you view losing trades as tuition payments for real-world market education, you can establish a reasonable monthly education budget. For example, if your account is $10,000 and you're willing to pay 5% monthly for your trading education, your monthly loss budget is $500. Tracking your losses against this budget creates a powerful psychological framework that reduces emotional reactions. When I implemented this approach, I found myself thinking, I'm still under my education budget this month, rather than, I can't believe I lost that money. This subtle reframing made an enormous difference in my trading psychology. What's your monthly education budget for trading losses? Share your approach in the comments. The 5 psychological hacks to lose like a professional. Now that we understand the importance of losses, let's explore specific techniques to handle them like a pro. 1. Pre-commitment to your stop loss. The time to decide where to exit a losing trade is before you enter, not while you're experiencing the emotional impact of watching it move against you. Professional traders use pre-commitment, deciding and setting their exact exit point before entering a position. This isn't just about putting a stop-loss order in your trading platform. It's about the psychological commitment to honor that stop-loss no matter what your emotions tell you in the moment. I use a written pre-commitment statement for every trade that includes my exact entry price, my stop-loss level, and the precise reason for placing it there, the maximum amount I'm willing to lose on this trade, in both percentage and dollar terms, a signature affirming my commitment to honor these parameters. This formal process might seem excessive, but it creates a psychological barrier against the in-the-moment rationalization that leads to moving stop losses and catastrophic losses. 2. The 10-minute rule. When a trade hits your stop loss, institute a mandatory 10-minute waiting period before placing your next trade. This cooling-off period allows your neurochemistry to reset, bringing blood flow back to your prefrontal cortex and enabling rational decision-making. During these 10 minutes, avoid watching the market. Instead, take a short walk. Practice 10 deep breathing cycles. Drink a glass of water. Write a brief note about the closed trade. This simple time buffer prevents the impulsive, emotionally charged decisions that typically follow a loss. 3. The loss reframe question. After every losing trade, ask yourself this powerful question. What would I pay for this specific lesson about the market or myself? For example, if a loss taught you that you tend to overtrade during certain market conditions, or that a particular setup doesn't work in a specific market environment, that's valuable information that will save you much more money in the future. Answering this question transforms losses from painful failures into valuable investments in your trading education. 4. The Loss Journal. Create a dedicated loss journal where you record and analyze every losing trade. For each loss, document the setup and your reasons for entering, market conditions at the time, your emotional state before, during, and after the trade, any rules you followed or broke, the specific lesson extracted from this loss, how you'll implement this lesson in future trades. Review this journal monthly to identify patterns and accelerate your learning. You'll be amazed at how quickly you can improve when you systematically extract wisdom from your losses. Do you keep a trading journal? Share what works for you in the comments. 5. The Professional's Loss Metric. Instead of obsessing over win rate, track your loss efficiency, how much you learn per dollar lost. This can be measured by dividing the number of new insights in your trading journal by your total losses for the month. For example, if you lost $1,000 in a month but documented 20 unique insights in your journal, your loss efficiency is 20 insights per $1,000, or 1 insight per $50 lost. The goal is to maximize this ratio, getting the most education for your tuition payment. This metric creates a completely different psychological relationship with losses. Instead of dreading them, you begin seeking maximum learning from each one. The counterintuitive path to trading mastery. The most profound trading paradox I've discovered is this: to become a consistently profitable trader, you must first become excellent at losing. This doesn't mean losing often or losing large amounts. It means losing properly, with acceptance, curiosity, and a commitment to improvement. When you master the art of losing well, winning takes care of itself. Here's a 3-step implementation plan to revolutionize your relationship with trading losses. This week, conduct a loss audit. Review your last 10 losing trades and for each one, identify what specific lesson could be extracted from this loss. Did I follow my trading rules? How did I respond emotionally? What would I do differently next time? This month, create your loss protocol. Develop a step-by-step protocol that automatically activates when a trade hits your stop loss. Include your cooling-off period duration. Questions you'll ask yourself. How you'll document the loss. A specific affirmation to reset your mindset. This quarter, build a loss metrics dashboard. Create a dashboard tracking your loss efficiency ratio, your average loss size, your emotional response score, 1 to 10 for each loss, your improvement in how quickly you return to neutral emotional state. Remember, the goal of trading isn't to avoid losses, it's to keep them small, controlled, and educational while allowing your winners to run. When you truly understand this concept, trading becomes less about prediction and more about probability management. If you found value in this article, hit that subscribe button for more insights on trading psychology and strategies. Comment below with your biggest takeaway about handling losses. I read and respond to every comment. What's one specific technique from this article you're going to implement in your trading? Share below and let's support each other's growth.